Welcome to the Explainer. Have you ever found yourself just staring at a stock chart, wondering what really makes that price line wiggle? Well, you're in exactly the right place. Today, we're going to peel back the layers, go behind the chart, and look at the raw engine that drives every single move, something called order flow.
It's the question, right? What really moves the market? So many people look for answers in the news or some complex indicator. But the real answer? It starts way deeper. It's in a fascinating field called market microstructure.
Okay, market microstructure. Sounds complicated, but think of it like the physics of the financial world. It's not just about what price an asset hits, it's about the nuts and bolts of how it gets there. We're talking about the actual rules of the game, the architecture of the exchange, and the mechanics of every single buy and sell order. So, if a price chart is the car you see driving down the road, then order flow, well, that's the engine under the hood. It's the raw, unfiltered data stream of every single buy and sell decision that, when you put them all together, creates the price movement we see on our screens.
Exactly. It's literally the market's DNA. This continuous stream of orders is like a real-time ledger of supply and demand. It shows you the collective psychology of everyone in the market, from the smallest retail trader all the way up to the biggest institutions, as it's happening second by second.
And this right here, this is the arena. This is where the battle happens. It's called the limit order book. Look, on one side, in blue, you've got the bids. These are passive buyers, just waiting patiently with their limit orders for the price to come down to them. Then, on the other side, in red, you have the asks, the passive sellers waiting for their price to be hit. The price only moves when someone aggressive comes in and starts taking out these resting orders.
So to really get what's happening in this arena, you've got to learn the two fundamental words in the market's language, passive and aggressive. And it all boils down to the two main ways you can place an order.
This really lays out the fundamental trade-off, doesn't it? If you use an aggressive market order, you are guaranteed to get into the trade right now, but you have no idea what the exact price will be. On the flip side, with a passive limit order, you get to name your price, but there's no guarantee your order will ever get filled. One takes liquidity from the market, the other provides it.
And that right there, that's the whole ballgame. Limit orders add depth. They create the pool of supply and demand that everyone else can trade against. They provide the liquidity. The aggressive market orders are the ones that jump into that pool and take the liquidity. It's this constant dance between providing and taking that actually makes the price go up or down. Okay, so this back and forth between passive and aggressive orders creates something we call market liquidity. And just like the seesaw on this slide suggests, liquidity has this direct but inverse relationship with another really important concept, volatility. So what is liquidity? Just think of it like the depth of a lake. A market with high liquidity is like a really deep lake. You could drop a giant boulder into it and it would barely make a ripple. But an illiquid market, that's more like a shallow puddle. Even a tiny pebble can cause a huge splash. And that brings us to what is basically a fundamental law of the market. It's simple. When liquidity dries up, meaning there are fewer passive orders sitting there in the book, even a small aggressive order can cause a massive price swing. That's exactly why low liquidity almost always equals high volatility.
And we see this playing out all the time in certain markets, right? Just think about the absolutely wild price swings you see in some cryptocurrencies or penny stocks. There are just fewer players, it's a shallower puddle, so any splash is going to be huge.
But on the other hand, you have markets like the S&P 500 or major forex pairs. These are incredibly deep oceans. Millions of participants are providing liquidity at any given moment. This depth absorbs all that buying and selling pressure, which usually leads to much more stable prices and lower volatility.
Okay, so we've got our battlefield, the order book. We understand the physics, liquidity, and volatility. But who are the generals leading the charge? This is where we get into the really cool idea of smart money.
This brilliant idea comes from something called Wyckoff theory. It's a mental model. It asks you to look at the market not as a bunch of random chaos, but as if it were all being orchestrated by one single, highly strategic operator. Now, this isn't some conspiracy theory. It's about understanding how the big institutions think and act. So this composite operator is really just a way to think about the combined force of all the big professional players, the hedge funds, the big banks, the major institutions. They have the capital, they have the strategy, and they can absolutely move markets. And their primary goal is pretty simple. Buy assets from people who are panicking and selling low, and then sell those same assets to people who are euphoric and buying high. And they tend to do this in a predictable four-phase cycle. It starts with accumulation. This is when they're quietly buying up everything when pessimism is high and nobody else wants it. Then comes the markup phase, where they start pushing prices higher. At the top, you get distribution. This is where they methodically sell off their holdings to an excited and often uninformed public. And what follows that? The final phase, the markdown, when prices fall. And then, the whole cycle starts all over again.
All right, so what's the big takeaway from all of this? I mean, how can we actually use this knowledge to read what the market is trying to tell us as the story is being written in real time?
Well, the answer is you have to look for their footprints, the footprints they leave behind in the order flow. It's all about spotting these imbalances between the aggressive buyers and the aggressive sellers, ideally before the big move really gets going.
What's great about this table is how simple it makes it look. When you see a constant wave of aggressive buy orders just eating through all the passive sellers at one price level and then moving up to the next, that is a massive clue. That's bullish pressure. And of course, the opposite is true. When you see sellers aggressively hitting the bids, just smashing the price down through support levels, that tells you pessimism is in control. You are literally watching the market tide shift right before your eyes.
So here's the most important thing to remember. This isn't about having a crystal ball to predict the future. Not at all. It's about fundamentally changing your perspective. You stop just reacting to prices wiggling on a chart, and you start to understand the forces of supply and demand that are actually creating those wiggles.
And that really brings us to the final and maybe the most important question. Analyzing order flow lets you see the footprints of the market's biggest players. So once you can see their tracks in the sand, you have a choice to make. Whose path are you going to follow? Thanks for joining us on The